Boom, boom, boom. Good morning, traders, and welcome back to another episode of Market in the Morning. I'm your host, Kevin Dubrisky, with the best market analysis tool in the game, MRKT AI. If you want to try it out, it's at MRKTedge.ai online. It is the best fundamental analysis tool out there. And we have a special guest today, CEO and co-founder Nilabh of Market AI. We're going to go over some fundamentals and give you guys some A+ setup. So make sure you hit that like button if you're ready, because Market in the Morning starts right now. Nilabh, man, good morning.
Good morning, Kevin. Good morning. Another week, and we're back. How's it going, my friend?
Yes, sir, dude. I'm doing good, man. Excuse me. Can't even catch my tongue this morning. I'm that excited about what's going on in the markets. We've been
Yeah,
seeing some crazy
I can
selling,
honestly, I can feel it from your voice that you're super excited.
bro. So excited, bro. And hopefully everybody in the chat's excited too. Drop some W's if you're excited. We got the one and only Nilabh in here. We're gonna cover some market analysis and find some trade setups.
Yeah, thanks, man. It's a lot has transpired since last Tuesday, and even on last Thursday when you had Jeev on, the other co-founder of Market, a lot's gone down. While we were iffy on whether we were going to get CPI or not, we didn't end up getting it despite optimism around the U.S. government and to a U.S. government shutdown, right? And it's been the longest shutdown in history, nearly going on for months and months, right? So it's been a very uncertain time when it comes to economic data, but there still has been a lot of other catalysts and that entire narrative that we were talking about last time really driving the markets. And currently, I don't know if you've noticed, but every single market has seen outflows over the past few days. And this all started here. We have GC, that which is just the same as XAUUSD if you trade the FX pair or if you trade the futures contracts. It's the same market, just different price and movement. Same with Bitcoin. Bitcoin saw outflows as well. And a
Yeah.
lot of traders were left confused on why this is happening, with especially with optimism around the US government and to the shutdown, right? But this is where that entire concept comes into play, is that, and we've talked about this before, Kevin, like we talked about this several times, but I just want to keep bringing it up until it's really drilled into people's heads. Because even when we do something bad, we don't learn it until it's the very last time, when we learn the hardest way. When you're speeding, you don't really learn to slow down until you crash the car, right? And then you're like, oh, I shouldn't have done this. And it's the same with the markets. We don't really learn from our mistakes until it really costs us. So last week would have been the end of the last week would have been the worst time to be buying any risky assets, right? Like BTC, like ES, just because of the pure bloodshed that we were seeing that was going on since last Wednesday. Now, the question is, why did this happen across global markets? It's very, very simple. You may not believe it, but we can check right here on what actually is driving all this bearish sentiment in the intraday timeframes. And a lot of it comes down to diminished rate cut odds. Now, what does this mean? Remember, we always talk about that markets are forward looking. Markets are always keeping track on what's to come, what could impact market. And this purely happens from the greedy nature of all market participants. This goes down to basically psychology level, right? Humans are driven by fear and greed, right? Money is just a byproduct of what we get when we act on these emotions in the market. So when we see over here that diminished rate cut odds are holding 30% weight, a stronger US dollar is holding another 35% weight. Overall, that's a 65% weighting on the bearish side for intraday on GC, right? For intraday on gold, on XAUUSD, right? Same with ES as well, Fed rate cut repricing. So market-based probabilities for a December rate cut drop below 50% after hawkish Fed commentary. And this weighs on all risk assets, right? It also weighs on gold and GC because they're dollar denominated. So when you see hawkish Fed, that means we're going to see further inflows into the US dollar. Because what does this mean? This means tighter financial conditions. This means capital is still going to be a bit more expensive, and that brings demand into the US dollar. Now, as you can tell, it's currently November 18th. We are still 2 to 3 weeks away from the next Fed rate decision, which is, I think, December 8th to the 9th is when the FOMC meets. Federal Open Market Committee is going to meet, and they're going to decide on the next move for the US interest rate. And if we go over to the Fed Watch tool, we can see that rate cut odds for December on the December 10th meeting have dropped to 46.4%.
Quick compare. Top left right under compact. Yeah, compare. And it'll show you where we were, like where we started. 90 was at 93% at some point for the
Yeah.
December cuts. And now right now we're at what, 40%?
Yeah, and here's a good example too. Is thanks for showing me this compare button.
Yep.
But if you look over here on November 11th, we were sitting at almost 67%, right? And then instantly on November 17th, we were down to 42%. But even between then, is that we got a headline that came in a few days ago talking about rate cut odds, right? So we could just bring that up, rate cut. I think this may be due to the Cloudflare issue that we're having. And you can see the headline is right here that the internet is kind of affected at the moment due to Cloudflare being down. So issues have been identified and a fix is being implemented. But we did get a headline that talked about rate cut odds dropping. And that was likely due to data that was released insider, right? We haven't really been getting the full picture from US economic data due to the US government shutdown, but we should start seeing it come in to flow as all these reporting agencies gather all their data and start reporting it again. But doesn't mean that these guys don't know what's happening behind the scenes. So that's where it comes, and you have to do an almost inference, and market is here to support that. Is that the main current driving factors across all markets is the Fed rate cut repricing. We went from a high expectation of a rate cut, and what that usually entails is you're going to see inflows into gold because gold performs great in a low rate environment. You're going to see inflows into your US equities because they perform great in a low rate cut environment. And we're just continuing to price in upcoming rate cuts. You're going to see BTC perform towards the upside if we were seeing an increased chances and a dovish Fed for December. But all of that was completely vanished, and we saw rate cut expectations again drop below 50%, which then further led to, you can see massive plays where the entire market was freaking out. They're like, oh, does this mean we're in a bear market? Does this mean that BTC is in a bear market? Right? And you'll see a lot of people use that term, and because they look at purely technicals. They see these lower highs being formed, and to them it is a complete bear market. When you zoom out, I think that one of the best things about being human is that we have the ability to look at things from a different perspective. We're not tied to just the lower time frame. We're not tied to just the intraday time frames or the higher time frames. We get to look at it all from a bigger picture. Now, if I pull up the Bitcoin chart from, let's say, we just look at it from December 2022, on the higher time frame, this looks very bullish. Looks like a normal retracement. But for someone who just trades, let's say, 30-minute or 15-minute and is more of an intraday trader who doesn't really look to hold these investments, this is a more bearish trend, right? So they're like, okay, we are entered into a technical bearish trend, but that is actually due to the fundamental factors behind it, right? The fundamental factors that are driving all markets currently, major of it being the rate cut odds, right? So this doesn't necessarily mean that we're in a bear environment. It just means that we are going to continue to see outflows until, and this is very important, we're going to see outflows until the market gets back to pricing in rate cut expectations. I want you to think of it like a balancing game. Not always are we going to run off the same list, right? In this case, we're not always going to be pricing in rate cut odds, but we do know that rate cuts are to come in the future. What meeting may they be? May they be in the January meeting, in the second meeting of 2026? I don't know. But all we know is that the markets are going to be right back on their game plan where they continue to price in rate cut expectations, right? I'm just going to go to GC over here. And again, like we can see that we know that gold tends to consolidate for a large period of time in these massive ranges. This isn't a small range, right? This is from 3,300 all the way to 3,550s. That's a pretty damn big range on gold to be playing where you can just play upside, downside, and really take key buy and short positions at key price levels and price sensitivity areas. But It always takes that one single catalyst, like in this case on August 22nd, where Jerome Powell took the dovish tilt at the Jackson Hole Symposium, which led to this massive upside play. Now, the question is, right, we just went through over 3 months of pricing in rate cut expectations. And now the market is just starting to push back on those rate cut expectations because CPI insider came out a little hotter than expected, right? There's still work to do in Fed's dual mandate policy, which is keeping maximum employment and making sure they achieve their price stability goals of 2%. So we're still far from that. It's not the job, as Kobe would say, the job isn't done. It's very clear, cut, simple, and that's what Jerome Powell approach that he took is that the job ain't done, guys. We're not done. Push back on the rate cut odds, and now we can clearly see how that played out on GC, on ES, and on BTC. But now the question is, are we going to go back into that sort of consolidation range where we just kind of play these buys and sells in this range until we get that catalyst, that single catalyst that ends up driving markets for the coming months, that prices in the next upcoming rate cuts, right? And that's something that's very important. And what we'll see most likely happen is that until we see that catalyst come in, we are likely to play in these ranges, which are still massive ranges, right? You can still see buying opportunities at key demand zone. You can still see short opportunities at key resistances, right? But it's to keep in mind and keep your expectations in line that we could experience something like this, right? Where you just see cut clear range where price isn't doing anything. It's just accumulating orders until you have Big Papa Powell come back into play and say, hey guys, we're going to start cutting rates again. We're in that part of the cycle. Inflation is doing well. Labor market we're seeing some instability, blah, blah, blah. The usual back and forth that these guys do. Okay. Yep. So that's what I personally have in mind, is that I'm not convinced that S&P has reached a complete top. Maybe it has, right? But if we zoom out, we are still very, very bullish. And what's to come? We know rate cuts are going to come. We know it's going to come. We know rates aren't going to be held at this high of a level, right? So it's just a matter of when will the market start pricing in those rate cuts. And there's a few ways that the market's going to start pricing it in. Either when we start seeing CPI, we start seeing PCE, these key inflation metrics that the Fed pays close attention to start coming down, start coming out in softer readings. They start coming out below what the markets are expecting them to come out. That is a signal that then we'll see rate cut odds jump up for the next meeting, right? Because if inflation's coming down, there's no reason for the rate to be held at the next meeting. And this is where we have to use our mind and be like, yes, markets are always forward looking. Yes, Kevin and Nilabh told me that markets are forward looking, that they're always looking at what the next catalyst is and trying to price in what's going to happen, right? And that's why over here, even when we go to ES, we can see it's rate cut repricing, because what was previously being priced in was the incoming rate cuts. The rate cuts in October, in December, that's what the markets were pricing in since August 22nd, where we even saw ES go from 64.21 all the way to nearly 7,000. That's a 500-point push towards the upside in just a matter of a few weeks, right? So it's really important that we understand that, okay, this doesn't mean that we're in an overall bear market now. It just means that we are seeing that repricing happening, because what was previously expected is no longer being expected by the markets anymore. They saw reduced chances of a rate cut, right? All the way from 67% down to now a 48% today, right? And even going as low as 42%. But you can see how dramatically things can shift. It just takes one inflation report that comes out softer than expectation to push these rate cut expectations back up. Or it takes a few cracks in labor market data to the markets being like, no, the Fed has to cut. And then you see this jump back above 50%. You see increased chances of rate cuts. And then you see those headlines coming in where it says that, oh, markets are pricing in rate cut odds are jumping in, and Fed will start coming out. So even here, higher than expected jobless claims signal labor market weakness, right? Increasing odds of a Fed rate cut and risk off sentiment. And this headline just came in 5 minutes ago, and market has marked it high impact. So we evaluate all headlines that come in, and we do a great job at determining which ones are high impact and which ones can really bring in those that catalyst that the markets are looking for. And even see jobless claims. Now data is being reported from October 18th because the US government is in that phase where they're trying to release data, because it's not just released by the government, right? There's different agencies that report this. There's Bureau of Labor Statistics, right, which is a government agency. There's ADP, which is a private agency. There are so many different agencies like S&P Global, which reports PMI figures, ISM, yeah, which reports again PMI figures for manufacturing, services sectors. So these are all independent agencies, some of them with the government, some of them independent contractors that collect data from businesses in terms of PMI. They go around asking different businesses whether they're experiencing contraction, how their business is doing, are they seeing new orders, how their employment, their hiring, their layoffs are going, and it all gets packaged into a survey like the PMI. So now you have all these different reporting agencies starting to pick back up and report the data. Now we're getting past data. We're more likely in the next coming weeks going to see inflation data from last week and what the actual result was. And I'm telling you, that result was not what the markets were expecting. The result is that the inflation probably came out higher than expected, which led to the entire markets pricing in the Fed rate cut, decrease in a December cut expectation, right? Now that I've yapped for a while, for about 17 minutes about what's going on in the markets, and we've even seen high impact news come in talking about how higher than expected jobless claim is signaling labor market weakness. Now, that's what I was talking about, is that it doesn't take much to turn that key, and the chances of a rate cut expectation increases. So in the coming weeks, we have to keep in mind, oh, another high impact headline came in, but this is more for Japan and China's diplomatic crisis. But it's important to watch in the coming weeks on how this rollout of data is really going to play and how it's going to impact the rate cut expectations. And more than likely, in the coming weeks and the coming months, we're going to see the cut expectations for the upcoming meetings, the forward-looking increase. And what's that going to do? It's going to see that inflow into gold again. We're going to see that inflows into BTC again. We're going to see that inflows into ES again. In my opinion, we still have clear upside on ES as well. It may, and I like to think in terms of long term. I don't focus on just the day, right? To me, you have to really look ahead and be like, okay, if the higher time frames and the intraday time frames are aligned and we have similar targets, I can confidently take that sort of play. But in this case, we've seen ESB slightly bearish on the intraday time frame since last week. So you've been able to take key sells at pullback levels or key consolidation areas. Like in this case, we can see that there's a very key demand zone over here to the left. And we are making our way slowly but surely into it and tapping into it. And this is, again, that same outflow that it's led by the Fed rate cut pricing. So we still have a bit more downside to go on ES before we probably see some sort of reaction from intraday buyers jump in. But if there's nothing to support that reaction where buying should take place, then we will continue to see an outflow and potentially head down to further levels of interest and maybe 64.20s, right? 63.30s, right? But this is the first area that we are currently seeing, which is 6,600 all the way down to 66.50s. This price sensitivity zone where we can see sellers still drive price into, since we are still in more of a bearish market structure and fundamentally bearish on the intraday time frames. That's correct. So when we do see something like that, and let's say, and this is just mapping out mental scenarios, and I think it's very important that as traders, we determine what the possible scenarios are, right? You want to be prepared for anything that takes place. In this case, we got the rate cut expectations drop. So where was the next logical area we could go to? Okay, first it's this wick. Let's fill this wick fill. Now, if we don't see anything change, if we don't see that rate cut expectations jump back up, we're going to see continued outflow. And this is the next logical area that we could head into.
Yeah, I like that. We have some questions in the chat about market. What's up, Javon? Asking how long has market data has been in the make? How long has market been in the making?
It's a fantastic question. Market is actually less than a year old right now. We are just about 2 weeks away from Market's first birthday. And in this case, I'm not even biased because there has been no platform that has iterated so quickly, so fast, and built what we have built in such a short period of time. These other market research platforms have been around for years. And I can confidently say that we came in, we innovated, and we started pushing people's boundaries and limits and forced them to innovate. This is what's great about competition is that it just takes one key player to start pushing a more stagnant industry that was previously just relying on trying to create scenarios with just purely economic data. But it's not just that. It's the forward-looking aspect of it. It's the high impact headlines that come in. What did Trump say? What did Powell say? How are central bank speakers leaning? You may not know this, but a lot of these central bank speakers say different things at the same time. Now, why does that happen? Well, that's very key, is because they play a balancing act game. If they were all talking about rate cut odds decreasing, you're going to see massive outflows. So you have to have few of the parrots, right? We call them parrots. Let's call them Fed parrots. Few of them will have to play the other side of the game, right? So market is just less than a year old. We're approaching on our 1 year birthday, and every single week we push out a major update. With our more recent one being these high impact headlines, we have a brand new economic calendar coming. It's the same calendar that's in the Bloomberg terminal, that's in London Stock Exchange's workspace terminal. So this is pure institutional intel that we're bringing to the retail space. And this was actually always my dream, is that I thought of this idea years back, but I didn't get to execute on it until start of 2024. So myself being a very technical person in terms of software in tech, I'm able to bring my vision to life by just thinking about certain things. And that's actually one of the advantages that I believe I have as a founder over other founders in the industry, is that none of them are technical. I can sit down. If Kevin has an idea, Kevin tells me the idea. I'm like, okay, cool. This is how we're going to approach it. And one day later, we have a
It's
working
out.
concept of it. Right, Kevin, you've seen that.
Nope.
And
Dude,
it's
it's
very
crazy.
phenomenal that how big that
Yep.
advantage actually plays out for us.
Yeah, no, it's crazy. I'll tell him an idea. I'll be like, yo, what about a search bar like this? What if we could go into live news, hit search, and have a filter? And then it's like out the next
Yeah,
day.
it's out the next day. And
Unstoppable,
exactly.
man.
And even we love listening to our users. Like a lot of my day, uh, I have several meetings throughout a week that are purely just user feedback meetings. And the best thing about this is that users tell me what their pain points are, what they're looking to see out of market, where they what their vision looks like for market. And I can most humbly say that the progress of market is largely driven by us talking to users, us taking in every feedback that one has to say, and then going and bringing it up to the team, be like, hey, this is what 30 people told me in the past 2 weeks. This is what we should do to figure out how to solve this pain point. And not a lot of platforms do this. But if there's any market users, my DMs are always open. Don't ever feel afraid to reach out to us, reach out to Kevin, reach out to myself. We're always looking to improve the platform and really see how you guys want to go about this. Like my entire goal is that I want market to be known by as something that was built by everybody in the community. I don't want all the credit, I don't want the team taking all the credit. I want everybody in the community to be like, hey, this is an idea I had. I told the market team and they went and implemented it. That to me brings a lot more satisfaction than trying to get on this show or something like that, get some clout from it. But but yes, that was a fantastic question. It's been 1 year. We are coming up on that in just a few short weeks, and we're doing our first ever sale starting this Friday for Black Friday, which I'm very excited to see because we had a lot of requests on people telling us, "Hey, are you guys going to do a sale?" We're like, we weren't planning on it, but Black Friday sale is coming, and this is going to be our first one ever. So as we just talked about, is that going back to the markets, that we can, of course, we are seeing some rejection on ES at 6644s, right? We can head off a bit deeper into these price sensitivity areas that we have mapped out on the intraday time frame here. There's some over here, right? And of course, like 6,800. But I do see a bit more further downside coming in unless we get some sort of catalyst that causes more inflows into S&P and other US equities, right? Even on gold over here, gold is just rejecting this current consolidation area over here, but it's still possible that we head up into 4100s. We reject that price sensitivity area and head a bit more towards the downside at 4,000. So because the sentiment hasn't overly changed yet, right? Yeah, we did just get a headline that is driving current price action, the same one where you can see that GC would see inflows, right? And now I go to GC, we can see that we are seeing those inflows come into the market since we did get that headline coming in and we saw that volatility pick back up. So it's very cool that how we're able to pinpoint certain events that happen in the markets and really see how they drive sentiment. And I love showing this example because it is it's an example that's really held weight throughout the markets for months. And a lot of users told me that this example woke them up from how the financial markets actually work. So right now I'm on our backtest fundamentals uh,
Nilabh, before
feature.
we get into the
Yeah,
backtest fundamentals, somebody had a great question that sort of
absolutely.
opens up the what's impacting tool. So if price is in the middle of a pullback and a target price, then do you have to just wait or can you trade towards when a news comes out? So I think that's a great question,
That is
especially for
that is a
what's
fantastic question.
impacting.
That is a fantastic question. And I'm going to answer this in a way where it makes sense to a lot more people. So here we have these pullback zones, right? Like you have a pullback level. You can see that the intraday is bearish. So logically, we have a bearish target. And a pullback level is going to serve as, okay, how can we get to this level? And what are we going to see? Are we going to see sells at this level? Are we going to see buys, right? So a pullback level in with the direction, you're aiming to look for sells. But with the question of how we just got this high impact headline come in, and this was data from October, it comes down to how comfortable you are with playing with fundamentals, right? Using the actual core mechanism of the markets. The markets don't run on your fair value gaps, they don't run on whatever pattern you're looking at, right? That is all. And I'm telling you, it is random. There is a very good book called Fooled by Randomness, which I highly hope people look up and read it because it talks about how much mathematical randomness plays in with the market. But the clear driving factors are okay. We're seeing diminished rate cut odds. We're seeing a stronger US dollar. So on our intraday time frame, logically, we're going to see more bearish price action play out in the markets. Now, if you see something like this happen and you see that inflows coming into the markets, you can 100% take that risk and be like, yes, you know what? I could see that sort of price movement happen, and this was 18 minutes ago, right? So it wasn't too long ago, but it was 18 minutes ago. We saw that inflow happen, and gold is now climbing towards the 4,100 or the next resistance and supply area as we're heading into here. So 100%. But it all comes down to one's ability to understand incoming data, break it down. And that's why we also build these, is that it tells you, it guides you, and you'll see traders reacting to it. Like I just reacted to it. There's 9 people who have reacted to this headline. So it shows up in the more in the popular, right? So 100%, you can always play the other side. And this is what happens is when data catches the market participants by surprise, you're going to see increased volatility. Let's say you're hoping CPI comes out, markets are expecting it to come out 2.7 and it comes out 2.5. Well, guess what? That's a big surprise, right? So now you're going to see gold continue to push up. You'll see ES push up. You'll see BTC push up because that's an increase in rate cut expectation. So you can always play the two sides of the coin, and this is where you have to adapt. A lot of people get stuck on a singular bias, and that this is where I was mentioning it takes one catalyst to completely remove this diminished rate cut expectations and us seeing just increased rate cut expectations for the next meeting. So it doesn't take more than a few catalysts. It could just be one, as I was mentioning, one jobs report. It could be single inflation report that comes out softer than the markets were expecting, and boom, rate cut expectations are right back on the table. And now you're seeing inflows in all these asset classes when previously, the previous week, we were just seeing outflows. This is the best thing about the markets is that they challenge you to think from a different point of view. You're not supposed to think in a linear manner. You're supposed to think in a much more focused where that's forward looking. You don't want to be left behind in of, hey, don't don't I don't want to think about, oh, Fed cut last time, we're still going to ride that. No, we're look forward looking now. We're looking at things that are coming few weeks down the line, right? And even sometimes you'll see the markets are forecasting inflation to drop, and the market participants will front run that. They'll front run that inflation expectation because let's say if you're expecting it to drop from 2.7 to 2.5, and that's what the expectations are, markets participants are greedy and they're going to continue to front run that. So it's always forward looking. Don't ever get too stuck up on your biases from last week. Things like that don't hold. The markets are hypersensitive to headlines, to economic data, to any probabilities for cuts being or rate decisions being priced in. And these are the driving factors. You have your central bank policy decision, you have your day to day economic data, right? And all of that, and you have the tones from all these central bank speakers, all geopolitics, right? All of these factors then build up what we see as the charts. You have to keep in mind that majority of the markets are run by algorithms. And I'm not talking about algorithms by ICT. I'm talking about pure institutional algorithms that have teams of 50 to 100 people, of quants, of mathematicians, of software engineers, of traders, of asset management managers, all focused on refining. And that's why when someone says they created an algorithm that's going to do this much return in the retail space, I call it bullshit, because you know how much effort it takes. And it's possible that they could do a small amount of returns, but real algorithms that run the market are built by teams of hundreds. There's a reason why BlackRock employs hundreds of people to run a single algorithm. Let's say Aladdin, that gets trillions of dollars passed through it every single day. So those algorithms are always taking in data faster than the human mind can ever comprehend. These algorithms are also located closest to NYSE, which gives them an advantage, and located closest to data centers that gives them an advantage to get this data to the very smallest amount of time. And then we get it after going through so many different providers and latency, right? In terms of like regular human readability data. But this is what it's important, is that these algorithms are always forward looking, and they're not looking at price action. They don't see price. They just see pure information. And then us as day traders, this is why we have charts, so we can visually understand what's happening in the markets. But when you have factors such as this, you're like, oh yeah, gold is bearish on the time frame because I know the factors are what's driving it. These factors are what drive price action. It's not the other way around. Don't ever get it twisted that it's the other way around. It's always real-time events. It's always monetary policy, economic data, geopolitics, what the president of United States is saying, what the head of the Federal Reserve is saying. All of these things are what create price action. And a lot of people get it twisted. It's a very symbiotic relationship. Is that price action and fundamentals work hand in hand together. It's not that one is better than the other, but when you understand both of them and you understand how to align yourself, even in the case of this question, is can you play the other side? Absolutely. Because now you see a headline come in that says, hey, gold is going to see continued upside. Now I can look for gold buys, let's say on the break and retest on the lower time frame, or after I see that volume start to pick up, and then we can head up towards our higher time frame targets, right? Or even our intraday target over here at 40.75, and you can see gold's likely to come right into it, right? But this is why we also have a higher time frame bias as well, which is still slightly bullish on gold due to safe haven demand. But again, Fed policy is still weighing on it, which is why we saw those 3-4 daily candles of just pure outflow.
Yeah. Absolutely. I'm glad you mentioned that because somebody had a great question too. Is it okay to set a limit order around the market pullback level? Guys, I'm gonna go with no, because we obviously don't want to be trading blindly. What market is here for is to help give us that extra insight, that institutional insight into what's fundamentally moving markets. So when our technical analysis lines up with it and says, hey, listen, this is a pullback level, and let's say you're a supply and demand trader, it's a supply zone too. Then yeah, you can put your limit order there. You can look to trade off of that. But
Yeah,
if that level sort of in the middle of nowhere, you're not too confident in it, don't take trades blindly. No matter what software you use, right? Everything needs to be a
exactly.
confluence.
Exactly. Everything needs to be a confluence, right? Market is a data terminal that's guiding users. No one wants you as a day trader, your entire first idea should be, hey, I'm here to gather bias. I'm here to understand what way volatility and volume is going to flow into the instrument that I trade. And then you have your own levels, like I have mapped out over here, right? I just placed this 75 level. And we can see we were just talking about how that headline led to the inflows, and we saw clean, excuse me, $20 move, at least minimum $20 move that happened on gold in the past 30 minutes. And now we are potentially going to see either rejection to this level or head up a bit deeper into the 4100s, right? So you don't want to just trade blindly. You want to use these as confluence. And this is why we have like what could push price up here. And it breaks it down like price holding about 4,000. Fed officials hint at dovish policy or rate cuts, which is weakening the US dollar. US employment data misses expectations, reducing Fed hawkishness. Keep this in mind. We had this from before, is that what could drive price to 40.75. And look at the headline we just got. Higher than expected jobless claims signaling labor market weakness, increasing odds of Fed rate cut, and risk off sentiment. Boom. That's exactly what played out in what could push price up to 40.75, which is so important that US employment data misses expectations, reducing Fed hawkishness, which is why we see odds of a rate cut just increase. So this is what I mean, is that you have these tools at your disposal. And it's time that, excuse me, it's time that retail stops operating from blindness and just paying attention to just levels of oh, this is a fair value gap, this is that, this that. Yes, you can do that, by all means do it, but I'm telling you, is that's not how the markets work. The markets are a very complex set of mechanisms that work hand in hand together, all driven by global central bank policy, incoming economic data, what the president of each country is saying, what the central bankers are doing, right? This all leads to inflows and outflows. And when money leaves one asset class, it doesn't just disappear, guys. It rotates. It rotates into different sectors. You may see it come from the tech sector into the defense sector, into utilities, right? This is a very common play, is that when you have risk off sentiment in US equities, you'll see money flow out of tech and flow into utilities, into the defensive positioning, right? So this is very crucial, is that money is always flowing, and it's always flowing based on what's happening now.
Right. That's right, guys. Awesome. Great stuff. Man, make sure you hit that like and subscribe button. Nilabh drops some amazing knowledge about what's going on in markets, how to use markets to really thrive in your own trading. And we have this show every Tuesday and Thursday. Every Tuesday with Nilabh and Thursday with Jeev, our other co-founder of Market. Really just breaking down the best analysis for you guys. And this is all for free on YouTube. So
Yes,
if that doesn't also speak volumes about what we do and what we try to bring to the everyday trader, we go
100%.
up and above. If you guys got any recommendations, anything you guys want to see, ever drop it in the comments. Let us know.
100%. And it's always a pleasure being on here. We are continuing to see more headlines come in. Not much impacting like gold at the moment, but these are just like some U.S. Saudi relations headlines for like trade deals and like nuclear deals. But
Yeah.
yeah, it's always great coming on, speaking about what's currently happening in the markets. And as you can see, things change fast. Last week we were talking about inflows into gold, and we were seeing that buying take place, and then we saw rate cut expectations drop, and boom, we got massive outflows across global markets. So when
Yep.
you truly understand this, you're not operating with blindness. You're operating with conviction. You're trading with conviction, and you're going to come out on top, because that's trading led by data. That's trading led by not some random probabilities of 60% upside here, 60%, 40% chance of downside. No, this is data. We're painting a narrative, and then you look at the narrative, you're like, I'm going to operate with pure confidence. This is the position I'm going to take, backed by 1, 2, 3 factors.
Right. Yep. Yep. Awesome. Could you check GDP AUD? We can. Do you want to check that one before we wrap the show up?
Absolutely, I can add that here, and then we can quickly GBP AUD. So we're still slightly bullish on GBP AUD due to RBA dovish minutes. So the Central Bank of Australia minutes released this morning signal cautious wait and see stance. disappointing AUD bulls and triggering renewed selling in AUD across major pairs. So what could possibly get us to this price target up here is, again, meeting minutes signaling possible dovish stance, right? Which we just saw more of a wait and see approach. We saw a Bank of England pills, speaker pills could boost GBP if hawkish tone supports rate hike. And then obviously, like, you have this other data down here. We have a more higher time frame bias as well, right? Which is just the higher time frame and for more swing traders, and then what could push price up and down over in this case. And these are the factors that are currently driving it on the higher time frame, with stronger Australian data, US macro weakness. So economic indicators soften with weaker GDP, easing wage pressures, and increased market pricing for a December Bank of England rate cut.
Awesome, man.
And we do this across anything. So like Apple, whether you want to know Apple, whether you want to know Tesla, Nvidia, like you have your Dow, like what's currently impacting all of these, right?
Yep. That's awesome, man. Guys, that easy. That you want to check something, it's that easy, that fast. What I like to do, guys, I trade the ES, the NQ. So I also like to keep the VIX on my watch list. So I can see, okay, is the VIX bullish? Is the VIX bearish? Because that will also give me confluence or give me an idea to say, hey, maybe I shouldn't be looking for longs if VIX is bullish.
Absolutely. Amazing.
Guys, I think that's a wrap for today's show. Nilabh, do you have anything last minute?
No, that's it, man. I had a great time. It's exciting to see how quickly markets change, but this is why you have to really be on top of what you're looking at, the research you're doing. And that's why we built Market, is to make your research easier to do. You don't have to be scouring through Twitter or multiple websites trying to piece things together. You come to one platform that gives you actual macro data that's not lagging, that doesn't just spew out random probabilities like 60% upside today, 40% downside. To me, that is just, who does that help? It's when you have a directional bias, you know how to act on it. You have a set of live news that comes in from straight institutional sources. You have pullback levels, targets that you can have full explanation of how we could reach here. And we saw it in real time. How could we reach here? US employment data reducing Fed hawkishness. And boom, we had a headline come in. If you go to high impact headlines, about 30 minutes ago, talking about jobless claims and labor market weakness, and boom, gold bulls right there. This is how it's done, guys. It's not magic. This is macroeconomics. This is geopolitics. This is real-time data at play. And I'm very, very happy on how we've built this and how much we continue to innovate and push things forward in the industry.
Yeah, dude, absolutely. I mean, we've gone from beginners, right? You said less than a year. 2 weeks is going to be a year data on market, and we're going to be leaders.
Absolutely, man. I appreciate all the support. Appreciate everybody asking the questions, and I'm excited to show you guys what we have in store for 2026, because we're not slowing down. We're here for domination, and I want you all to believe that market is here to stay, and market is here to dominate over every other platform that currently exists.
That's right. That's right. Market ain't going anywhere. We're just going higher from here.
It's kill or be killed, am I right? The market isn't dying.
Nope. No, sir.
But amazing. Thanks a lot for having me, Kevin.
No problem. Guys, have a great rest of your day. Hit that like and subscribe, and we will see you next time.